The business model of a company is reflected in its financial statements. Here are the balance sheets and income statements of two fictitious companies that are representative of the service sector and the industrial sector. You will see that the balance sheet items are expressed as a percentage of a total balance sheet to make them easier to interpret. The assets on the service sector company balance sheet show relatively low tangible fixed assets, a lack of inventories, and a predominance of accounts receivable. Indeed, services such as consulting may be provided over long periods, and clients generally pay when the assignment has been completed. The industrial sector, on the other hand, typically has significant tangible fixed assets, such as factories and production equipment. Inventories may be larger or smaller, depending on the industrial specialization in question, and the accounts receivable also varies according to the distribution channels. If you look at equity and liabilities, you see that the financing of these assets is essentially by shareholders' equity for the service sector and by shareholder equity and debt for the industrial sectors. The income statements shown by type of expense also enable the identification of the main production factors used by each sector. The values are shown as a percentage of sale. You will note that the highest costs for a service company are labor costs. For the industrial sector, consumption is spread more widely between raw materials, labor, and depreciation for the period. Here are the financial statements for the retail and luxury sectors. You can observe that the structure of the assets is similar, but there is more weight for intangible assets in the luxury sector due to the acquired brands. Inventories of finished goods such as alcohol or inventories of raw materials such as leather or silk are also higher. On the other hand, the structure of financing is very different for the two sectors. The retail sector uses three sources of financing: shareholder equity, debt to financial institutions, and above all to suppliers. However, the luxury sector is not indebted and provides internal financing mainly via its extremely profitable business. To see this, just compare their respective income statements. This time, the income statements are presented by function, and in this case, expenses are allocated to the major company functions such as production, distribution, marketing, and administration. This presentation highlights the gross margin, which illustrates the income generated by the production function. You will notice that it's 3 times higher in the luxury sector than in retail. Net income follows this trend. If you now want to see how the financial statements are drawn up, check out the next model.